You may be wondering, how do I find good companies to invest in as a 17-year-old with no degree in finance or accounting? I used a simple blueprint that my mentors have been using and it worked. I bought 4 stocks that yielded over 100%, all of which were the biggest positions in my portfolio. I've got 3 main rules. So you have to have an ecosystem, one that's scalable, and one that is a great prospect for profitability because of a heavy marketing spend or the sheer seasonality of the business and its performance. And those traits seem to be monopolistic, but in reality, that's what a solid business does. A great business provides an opportunity for its customers to deal with everything through their ecosystem. The main purpose of the environment in which a customer will be operating is to decrease general acquisition costs because of expenses for the client reduced in the future and revenues generated at higher rates because of upsells and cross-sells in the family of tools, apps, or whatever a company offers. Now this relates to the second point. Once you've got a system that kind of makes you dependent on it, the next factor that comes into play is the scalability of that system and whether the business can expand and reach more clients. Market penetration, for example, is the most basic and theoretically the safest way to acquire new clients, yet in companies that are developing and are just starting off, it requires high marketing expenses. In Hims and Hers, for example, marketing accounts for 50% of revenues, which is a lot, but considering the fact that it is a recurring subscription-based service, meaning that they have regular and scheduled purchases of the product, makes it very important to spend a lot on marketing and get the customers to convert to buy the product and then start being dependent on it. And psychologically, it's less demanding for a person to commit to 4 smaller expenses on a recurring basis rather than 1 every year or so. Additionally, not only companies that are strictly health related, but tech companies like Palantir or Shopify make it essential for staying with them even when your business reaches new highs and you've got your whole business set up on their platform, which makes it vital to stay in there because it proved to be effective when it comes to scaling your business. And this just benefits the companies because they will have increased margins because of the know-how or enterprise knowledge and experience that the company has in order to support their operations. And this translates to the company being a prospect for high cash flow margins and high net income margins. Depending on how you value a company, both are very important, but when investing in companies that are growing and have recently become profitable, it is important to see whether the business itself does well in the back end. High EBITDA margins, for example, are a sign of incoming future net income. I've said before that companies will spend a lot on marketing, and most of the times we want to see marketing or sales acceleration related metrics to be high. We don't want to see the cost of goods sold or cost of revenues being extremely high, because that means that our company is rather asset heavy, and it also makes scaling much harder because of the variable costs increasing along with more goods sold. Essentially, we want to bet on companies that can have products, but those products are service-based, where they have the know-how and have the solutions for you to get those products, but aren't strictly responsible for manufacturing those goods. And this relates to the health of their balance sheet. A balance sheet is pretty much a health report, literally. A balance sheet is a representation of the company's body. There are assets and there are liabilities. Assets are good and liabilities are bad. We want the company to have more assets than liabilities, and preferably more cash or short-term assets, meaning things that can be liquidated into cash in a ratio to their short-term liabilities. Additionally, if you see that a company has little cash and huge amounts of debt, you must look at the interest expense, meaning what they spend to actually pay that debt off. And if the expenses are high, it means that the cash flow margin is going to be affected by it, and we don't want anything of that. We want companies that have a already healthy balance sheet, and it doesn't necessarily have to be updated. For example, a company that has gone into a merger doesn't have to report the changes to its balance sheet up until the quarter that they have announced the transaction in. They may report results from Q4, but the company decided to merge with another business in Q1, which means that the results for their Q4 and full year are going to differ from Q1, and you may also use it to your advantage because it will seem like the business is in a mostly worse situation than it will have been in the next 3 months or the quarter. The smaller a company is, the more probable is the fact that it is going to be mispriced based on trending news or noise, which is essentially the flow of information that may distort a perception of what a company really is like.